battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office for the past 45 long years. It's been the Stenger family's mission to deliver you clarity and confidence to help secure your financial future. You're like, Nick, where were you? What were you up to? We were working hard and meeting with clients and getting everybody up to date on their plans, but let not your heart be troubled. Here we are. We're back in the studio, and I am going to just tell you that we are basically almost full on Investor Day. You've been thinking about registering. It's basically almost full. By the time this episode comes out, it may be already too late, but give it a shot. Go register at the site that will be linked in the YouTube comments section or the description of the video. And make sure you sign up. There's probably a couple spots left still, but it is almost full. We're looking forward to it. Added Ed Yardeni as a speaker October 8th and 9th in Oak Brook, Illinois, right outside of the city, so don't miss Investor Day. And here we are with episode 225, Blowout earnings season. Absolutely incredible, the numbers we're seeing with earnings on the S&P 500 for the second quarter. The first quarter, remember, was a blowout earnings quarter as well, and the second quarter is actually even better than the first by a long, long shot. And so if you went back to what expectations were for earnings growth in January, February of this year, people thought we'd get 12% earnings growth, which is not bad. You could build a really nice portfolio off of a 12% earnings growth number. Well, all of a sudden, S&P companies came out, and I've got all the documents here in front of me today. For the first quarter, people were thinking we were going to get 12. We ended up at 23, 24% growth. Here's the second quarter now. If you can believe this, the second quarter, S&P is likely to report earnings growth over 29%. Can you believe it? I mean, you look at these numbers. I had to read them 4 times. I'm thinking to myself, there's no way somebody got something wrong. No, these are the real numbers. And it's not just 7 companies. It's not just 7 stocks. It's the widening out of where the return is coming from. So all these goofballs who said, oh, this is a bear market because only 7 stocks are leading the charge. This is a bear market because it's only tech. They're just wrong. They're not showing you the real data. They're trying to tell a narrative. And you've got to understand, depending on the news you consume, the people you listen to, the books you read, the podcast, all the stuff that you consume is going to culminate to a point where it influences your opinion and then your behavior. And so garbage in is garbage out. If you consume a bunch of nonsense and you consume a bunch of bearish research and people who have an agenda trying to sell you something, it's no surprise to me why we get calls from clients sometimes saying, Nick, the sky is falling. I don't know what to do. I got to get into gold bars. And I'm saying the portfolio is at record all-time highs. The S&P is at almost 7,600, which was the record all-time high. Remember, we said 7,722. Coming into the year, 7,722, we got to 7,600. I mean, how much closer do you want to be? We revised our estimate a couple weeks ago on the mid-year outlook. I told you I think we're going to 8,000 here. I could be a little off on the timing with the midterms and all the rest of it, but 8,000. So the only way that you feel bad about the market is because you are just consuming a bunch of nonsense. And so you need to get yourself exposed to the data, and not just exposed to it, but you need to get into it. You need to read it. You need to understand the math of how this works, because that's the guiding light of the actual portfolio's results over time. It's simply that the market follows earnings. If you have a company that does well, company's stock price and it's going up, chances are that earnings have already been projected to go up or have gone up. And so again, the market and earnings are tied together at the hip, and sometimes earnings are a little bit under where the market would be, a little bit over. If earnings aren't coming in as good as the market would suggest, then you have a correction. If you have the opposite thing, which we had coming out of 08 and 09, where the market was well under where the reality of the earnings supported, you have massive gains. And so this idea that there's any other lever that gets pulled in the market other than earnings is just based on a fantasy. It's not real. Now, that being said, the Fed does impact stock market prices. And so if you have great earnings and you have a really easy Fed, your stock price is probably going to go up more than it should in the short run. If you have a really tough Fed and your earnings are great, your stock price might go down a little bit in the short run. But I'm talking about the short run here. I'm not talking about the long run. In the long run, there's nothing else that matters than a company's earnings as far as stock market investing is concerned. So I'm sitting there watching CNBC the other day, and my middle son, Hank, he likes to get up early. He gets up at the crack of dawn like me. We're sitting there at 5:30 a.m. watching CNBC, and he's learning about the markets. He's 18 months. He's hearing about NVIDIA and Apple and Amazon and the Fed rate hikes, and he's just taking it all in. And they say on the TV, somebody says, hang on a second. And by the way, this was Ed Yardeni, who was being interviewed at the time. He's coming to Investor Day with us here in October in person. You can't miss him. But Ed Yardeni is getting interviewed by CNBC commentators. And he's saying, I think earnings are going to be $400 next year on the S&P for 2027. Historically, earnings have been worth 20 times. So 20 times 400 is 8,000. And the commentator goes, it can't be that easy. There's no way it's that simple. And I think this speaks to the heart of why people get so goofed up in the stock market and make really bad decisions, because they really just don't understand businesses. And they don't understand accounting. They don't understand the P&Ls of a business and what the levers are that you pull to increase those margins that you have. And so that's the problem. That's the underlying reality of what some people really believe. It can't be that easy. I'm here to tell you today it is that easy. It's simply earnings times price. And so then you say, well, wait a second, what about the Fed? And what about Iran? And what about the tariffs? And what about all these geopolitical events? Forget it. Forget the nonsense of all this noise out there, because you have to ask yourself, what am I concerned about? Am I concerned about the short run with the portfolio, or am I concerned about the long run of the portfolio? And you shouldn't, I would argue, be in stocks if you're on a short run time horizon. If you're trying to buy a house in 3 months and you need $1 million from your portfolio or whatever it is you're going to pay, well, why in the world would you put that in the stock market in the first place? So the fact that you're worried about the market in that example is on you. That's your fault. You should not have put the money in the market. If you are on a long-term goals-based plan and your main objective is to retire at 60 and live till into your 90s without running out of money, if that's your plan, like most of our plans that we would have, well, how in the world are you going to worry about the stock market every time it goes down? You'd be literally worrying twice a year, 3 times a year. You can't get into this game of worrying about the market. So I have clients who assure me, they're like, Nick, I never look at it. I never pay attention. Don't worry about me. I never look. We have all the data. We can see they log in 55 times a week and looking at their portfolio. Stop doing that. Stop doing this to yourself. Just get outside, pick a different hobby, do something else. You get a golden retriever puppy. Now you got to take the dog out for a walk. Now you're probably not looking at your Schwab app too much or your Robinhood, whatever. Do something else. Probably for some people, the best investment they could ever make is you just buy a golden retriever puppy, so now you have something else to occupy your time. So all that to say, the market will go to these numbers that Yardeni's talking about, that we've said, that Tom Lee has said, that's our other speaker at Investor Day, to that 8,000-point zone. We're not going to tell you at Stenger Family Office the day and time we're going to hit it. We're not going to tell you that there's not going to be a pullback or a correction. And the faster that you get comfortable with the idea that a correction is always looming, a correction is coming, the better off you're going to be. The better off you're going to be going through these crises, because now you can actually build a plan off of some known factors. So when you think about two different sides of your thinking with the financial plan, you have knowns and you have unknowns. And what you can't do is sit there and worry about the unknowns, because if you worry about unknowns for your entire life, you would never leave your house. You'd just stay in the basement and pretty much not do anything. Well, we all act differently in real life. None of us actually do that. And we have to take risk. We have to take some sort of calculated risk. And so once we have ignored the unknown risks and we've just dealt with, the idea that we can only control the known risks in life, well, then we can put some planning behind that. And the known risks are that when the tide goes out, you find out who's swimming naked. That's Warren Buffett. Great quote, just to say, watch your leverage. You can absolutely control your leverage. I see people, and I don't want to name too many folks here, but millennials, Gen Z, okay, we see this all the time. And they're like, Nick, I can't, these houses are so expensive. I don't know what to do. And it's hard to come up with a down payment. And it's like, yeah, that is a real problem. But let me look at your credit card statement for a second. And then you realize that they're spending $6 a day at Starbucks. They're door dashing ice cream to their apartment for $40. Their rent is like $3,000 for a studio downtown because they want all the amenities. And they're going to Europe with their friends, spending $20,000 on a trip to Europe. And you're like, well, there's the problem, right? This is the issue. So you can control those things. You can control your budget. You can control your expenses. You can control, to an extent, your leverage. And you don't have to take on leverage if you live a conservative lifestyle. And so these are the things we all should be controlling. When we get to retirement age, we get to 60 or 65, we tell people, hey, pay off your debt. And yeah, you might have a low interest mortgage, a 3% mortgage. Okay, we can work around that and maybe structure that into a couple years to pay it down to keep you in certain tax brackets. Sure. But for the most part, all those installment loans and car loans and all this nonsense that people carry into retirement should be paid off. And I would argue you shouldn't go into retirement unless you have a lot of that stuff done with. And so that's your first thing you start with, because when the market inevitably goes down, or you have a credit cycle, or the Fed does a massive rate hike, or you have all these different one-offs like massive job loss and these things that can come up, you just don't want to be leveraged. The leverage makes you look good when times are good, but it can actually wipe you out. Not just make you look bad when times are bad, but actually wipe you out. That's how leverage works. And companies are no different. And so same thing at Stenger Family Office. We take it very seriously. We've built a great balance sheet. We say we don't want to have debt at Stenger Family Office. And, could we grow a little bit faster as a business with debt? Sure. But to us, it's not worth it. We want to be conservative. We want to make sure we can get through bad times. And I learned that from my dad, who started the group. And you have to be prepared for corrections. You got to be prepared for 20, 30, 40% downturns. How are you going to do that if you have leverage? You can't do it. So that is the number one thing that you can watch as we go through these times. But all this to say, to go back to the CNBC commentator's main point, which is it can't be that simple. It is that simple. I'm here today to tell you it is that simple. If you raise your revenues over time by taking care of customers, that's the formula. Take good care of your customers, give them a product and service they want, deliver value. If you do that consistently over time, your revenues will go up. If your revenues go up, don't worry about anything else, because the value of the business will go up. And if you own a mechanic shop, or you have a restaurant, or you have a beauty salon, or any number of small businesses that people have, think about everything else with the macroeconomy in terms of the microeconomy. These business owners that have done a great job, and we all know a handful of them where you go in to see them and they take great care of you and they know who you are and they work hard to do a good job for you and have a great product and service. We all know those people. What do? We give them more business over time, and it's no different with the big businesses. It's just done on a much bigger scale. That's what you have in your portfolio. You have a collection of these massive companies, and by the way, the bigger and bigger they get, it's not to say they're completely insulated from downturns. It's not that they're completely insulated from problems that can come up, and they do step on rakes once in a while, but they have some of the best management teams they've ever had. These people go to work every day to solve problems. And so just like you're worried about the 10 or 20 things that could happen, the unknowns, so are they. They're preparing, if they're a good company, for the bad times. And so what do they do to prepare? They build up cash. They build up reserves. They have emergencies funds. They pay down debt. And they just run their business conservatively, because if there's the end of a cycle coming, they want to make sure they don't get wiped out. That's why you've seen a lot of these companies last for decades and decades and decades. So anyways, all this to say, it's not really that complicated, other than the fact that you buy good businesses and you hold them for a long period of time, and that's the bedrock of being able to beat inflation. So I was doing a presentation for some folks the other week on their 401k plan, and we opened it up to sort of a town hall type discussion where people could ask questions and talk about some of their concerns. And we got into the topic of inflation, and we talked about the fact that over time, equities, that stocks beat inflation. And somebody said, well, how is that possible? Why is it that equities have been the absolute best beating asset class for inflationary purposes? And how is it that we've had a 40-50% run up in inflation over the past 5-6 years since COVID started? And these businesses are still around and they're profitable. Well, what they've done simply is raise their prices in real time to beat the higher prices. That's number one. So if you just want to match inflation as a company, what you do is you raise your revenues in real time. You raise some of your prices to deal with higher input costs. So that's number one. Think about McDonald's. All their burger meat and lettuce and buns and mayonnaise, whatever they're putting into the sandwich is more expensive today than it was 5-6 years ago. So the cost of the Big Mac to you is more expensive. So that's why inflation is a hidden tax that nobody wants to really point out, especially the politicians, because inflation allows them to not have to raise your taxes. But in reality, inflation's a tax, especially if you don't have assets. And so that's why McDonald's is still in business for the past 6 years now. They just keep raising the price of the Big Mac, and they're able to keep up with their margins. But the second way, and this is much more important even than the first way, is the technology. And so if you don't understand technology, you are really going to miss this. You're going to miss the run-up in the S&P the next 5 years, just like we've had the past 5. And remember, we've been through this with people now for a long time at Stenger Family Office. Every single year there's reasons to panic. Every 5 years, every 10 years, there's something really bad that happens in the market to the point where people lose their confidence in equities. They get shaken off the idea of holding stocks sometimes. And so what you have to just go back to is this idea that equities over time are beating inflation, not just because they're raising their prices, but because technology has never moved as fast as it does today. And so when you think about the industrial revolutions in the country, today we're in the fourth industrial revolution. We had we had machinery, we had all this improvement in productivity and improvements in safety and labor and all the rest of it over the past 100, 200 years in the United States. Well, today we're in this AI industrial revolution. Now, some of it's nonsense. Some of it's not going to work. Some of it's going to have to be unwound probably. There's companies delivering AI agents today that nobody even asked for. So some of that's the excess of what we're seeing. But a lot of this, the heart of AI, is not really the end user experience with ChatGPT or Claude, although that's cool. The end game here, and what's really important to understand, is that compute speeds have gone to the point that they've never been at. And this is exactly what happens with Moore's Law. A lot of people think Moore's Law is dead because it says technology doubles every couple years. They think it's almost faster than that. Fine. But the point is that technology moves faster and faster every year. What's happening with AI is not just the end user experience. It's the fact that compute speed has never been this good. That's why you're seeing the chip manufacturers print the earnings numbers they're printing. That's why you're seeing NVIDIA where it's at. That's why you're seeing data centers. And we can hate data centers, like it, whatever. I'm not making a point about data centers. I'm just telling you why you're seeing some of the stuff today is because compute speed is allowing it. That is never going anywhere. So forget AI. I don't know if AI makes it in 5 years or not. Maybe it all blows up like the Tower of Babel, like I've said in the past. But the more important piece is the compute speeds. The chips are good enough to deliver what we are doing today. And that's the miracle of innovation, the fact that companies are doing more with less. And so if you're McDonald's, what do you do today in 2026 that you didn't do in 1986? Well, you have a kiosk that people can punch their order in and order their lunch. And that's pretty much a miracle. And so what you have to also be careful of in the equity market is not taking technology for granted. I see people all the time. We were talking about this internally at Stenger Family Office where, you order something on Amazon and instead of coming in 4 hours, it comes in 2 days. And you're like, you're upset. You're like, what in the world, guys? I needed this, and it came in 2 days. It still came in 2 days. You ordered something on an app on your phone, and it showed up at your house 2 days later. Okay, that is an actual miracle. And you should stop and think, this is amazing. I mean, we have never lived in a time like we're living today. You can pull up an app on your phone, and a private chauffeur will come pick you up at your house and take you to the airport in like 7 minutes. Okay, that is an actual miracle, especially if you remember having to call up a cab and the cab takes like an hour and a half to get you if it comes at all. Okay, well, this is an actual miracle what's gone on in the U.S. economy. And so you have to understand on a much bigger level, we are absolutely seeing a miracle with the way that companies are able to leverage technology. It has never been to the point today where somebody could sit in their basement, code an app, and have a business that's worth millions of dollars in a few years and employ people and pay all these taxes like we do today. I mean, it's absolutely incredible what's gone on. And so companies are leveraging this at scale. They're doing big data projects that used to take a year or 2 or 3 years to get through. They're doing them faster than ever before in like a week or 2 weeks with NVIDIA GPUs. I mean, this is the reality of what's going on. And so if you miss this stuff, you're going to miss the equity run-up, you're going to miss the returns, and you're going to panic and you're going to sell because you don't understand what's going on underneath the surface. So with that being said, you're seeing that 29% headline number with earnings growth. Would you want to guess what the number one sector is in earnings surprises now for the second quarter? If you think it's information technology, if you think technology is leading the charge in the second quarter, you would be badly mistaken. You know what the number one sector level earnings surprise is for Q2? The number one industry that's doing the best right now for earnings surprises? Consumer discretionary. Companies like Amazon, companies like TJ Maxx, companies where you maybe don't have to buy their product, but you do, you like it, it's a good thing, Costco, something like that. Consumer discretionary. Now, think about how this possibly could be. You know, I've heard this narrative that everything's horrible and awful and the economy's bad and people don't have money to spend. How in the world is it that the earnings surprises to the upside, the best earnings surprises to the tune of 44.3% earnings surprises are coming from consumer discretionary? Well, people must have money to spend still. And so as long as the economy is still humming along with consumer spending, you're going to see this bull market continue. Now, number two is infotech, information technology. You remember that 44.3% surprise number on consumer discretionary? Listen to technology, only a 15.6% surprise. Absolutely incredible, but nowhere close to discretionary. Let's talk about another surprising sector that's absolutely blown it out of the park here, financials. The financial services industry, this is straight from FactSet Research, the financial services industry is expected to report the third highest earnings growth rate in the sector at 3%. All three sub-industries of the sector have year-over-year earnings growth, including financial services that are diversified, transaction and payment processing services, and multi-sector holdings. Listen to the capital markets business. This is IPOs. When you have IPOs, it means the economy's doing well. The capital markets business is reporting the highest earnings growth rate of the financial services sector at 15%. Blowout record all-time high earnings. Remember, earnings lead price. You start to see this in the economy. So this is not based on a fantasy. It's not a fugazi woozy wazi. It's not built on this idea that we're just hoping that things work out. We're in this big melt up. Jeremy Grantham was on CNBC the other week and debating it out with Joe Kernan, who pretty much, I think, rightfully called him out and said, look, you know, Jeremy Grantham, you're a historical bear. You're always bearish. You've been saying that the market's going to collapse any day now. You called the past 7 of the past 2 recessions. At what point in time are you going to own up to this and tell people, I was wrong, I'm sorry? I mean, these people never say sorry, and they should, because you have to understand they've cost people billions and billions and billions of dollars of investment value by being bearish. So you know, you're watching this debate, and you're hearing Jeremy Grantham defend, oh, we're in this slow melt-up. We're in this slow melt-up. Well, yeah, we're in a melt-up because the earnings have also melted up. So you're going to see these record all-time high numbers in the S&P because you're seeing record all-time high earnings numbers. You've gone from 3,000 points on the S&P in 2019 to today, as we sit here filming the show, 7,550 on the S&P, more than double since 2019. And you feel like this is the worst it's ever been? Really? And then you're going to see 8,000 points and say, this can't be real. This is ridiculous. Then you're going to see 9,000, and then you're going to see 10. And that's where I think ultimately the S&P is headed the next 2 to 3 years, which, by the way, is in line with averages over the long run. And when you see that 10,000 point number on the S&P, what are you going to do? You're going to say, oh, I can't get in now. I can't, it's definitely got to be a bubble now. Not if the earnings support it. Not if the earnings are $500 over the next 4 years. And you're telling me you don't think we can go from $400 in earnings in 2027 to $500 in 2030? I would argue that you're not looking at the data. You don't understand the technology, because these little improvements in tech that we're making each and every year, these much bigger improvements we're making in tech each and every year, lead to massive earnings growth. There's just massive earnings growth. And by the way, even if you only grow your revenues at a company 6, 7, 8%, that's okay, because if you're using tech, you have what's called operating leverage, and you, in a lot of cases, can see 10, 12, 15% annualized earnings growth. Is that any different than what we've seen the past 200 years? I'd argue no. Dr. Siegel would certainly tell you no. From the Wharton School, Dr. Siegel would tell you for the past 200 years, S&P's compounded at 10% a year. Why? Earnings have basically compounded at 10% a year. How are you going to argue against the reality of earnings? The only time I'll get bearish, and I will get bearish at some point, the only time, though, will be if the earnings don't support the price. And we have done that at Stenger Family Office. We told you in 1999 that the earnings did not support the valuations on the market. S&P was trading 45 times earnings. Today it trades 21, 22. How are you going to say that this is a bubble at 21, 22? At 45, sure. At 20, 21, 22, the 10-year average, the 15-year average, listen to some of these numbers. You're going to hear some of these stats. You're going to say there's no way this could be a bubble. Here we go. Earnings guidance. 62 companies on the S&P so far have issued positive EPS guidance. The forward 12-month price-to-earnings ratio for the S&P is 20.5. The 5-year average is only 19.9. The 10-year average is 19. Does that sound like a bubble to you? I certainly don't think so. And I think anybody who's telling you that probably is trying to sell you a product that is not S&P 500, not top 50 of the S&P, not the best and brightest companies in the U.S. They're trying to sell you something that carries a 2, 3, 4% sales charge or a much higher expense ratio than you really need to be paying because they want to sell you complexity. What's wrong with just owning Costco for the next 100 years? What's wrong with Procter & Gamble? What's wrong with Home Depot? What's wrong with Microsoft? What's wrong with these great U.S. companies? I want to hear one good answer why you would sell your Costco stock and go into an annuity. I mean, please, somebody in the comments, somebody somewhere, make the argument to sell Costco so that you could buy an annuity. Really? You're going to sell Microsoft so you could sit in gold bars and hang out with your gold bars in the bunker you built in your backyard? Really? I mean, I just don't understand the case. And the only case would be because the annuity comes with the 7% sales charge that the advisor gets right up front. And if you're selling those as an advisor, I would really question your ability to call yourself an advisor, because really what you are is a broker. You're selling a product. So let's say it for what it really is. Are you actually on a plan? Are you on a goals-based plan that relies on disciplined compound interest over time? There is no fast and quick, easy way to wealth. It's slow over time. The tortoise wins the race, and the tortoise is compound interest over time. That's it. You want to put a portfolio together. You're starting out. You're 30 years old. We've all read the story of the Costco guy who made $33 an hour. He's got over $1 million in his 401k. That's real. I've got clients that are just like that. Clients that made less than $33 an hour, and they have more than $1 million in their 401k. So this is real. This isn't just a one-off. It can be done. You're sitting at home. I'm 30 years old. I'm 40 years old. How am I going to do this? How am I going to put this together? You got to start today, and you got to start buying great companies. That's what we're here to help you with. We're here to, A, get you on a great goals-based plan, tell you what you need to do to accomplish what you want to accomplish, and number two, to get you in companies and coach you on these plans and coach you on these companies so you don't blow it all up on accident next time you see a bad headline. That's it. That's the model of wealth creation over time. And it's certainly made a lot of millionaires like the Costco guy like a lot of our clients, and it's going to do the same thing for you over time. So thank you for being on. So appreciate you coming back each and every week to the show. Don't forget to share it, subscribe to it. Really helps us out when you subscribe. And come to Investor Day. Again, a couple spots left remaining that you could sign up and come see us in person. We'd love to see you October 8th and 9th this year in Oak Brook, Illinois. And other than that, we'll see you next time.